Hello, welcome to the TnT Podcast. This is Lindsey.
And Thomas Lindsey.
And let's get into it. We're doing the 2018 letter. This is going to be a live stream, but it's going to be pre-recorded, so I'll be in the chat, but I won't be like actively speaking in the chat. I'll be speaking in the chat like when it comes out to answer any of your guys' questions. All right, let's get into this.
Okay, Berkshire's performance versus S&P 500. We're reading the 2018 letter to the shareholders by Warren Buffett.
Yeah, it looks like Berkshire Hathaway is around 20%. Your S&P 500 is around 9.7%. So yeah.
You're looking at the compounded annual gain from 1965 to 2018.
Yeah, so it looks like your best bet was definitely Berkshire. So yeah.
Well, compared to the S&P 500 for certain.
Yeah.
Okay, so we're going to scroll on past that and I'll go ahead. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Inc. Berkshire earned $4.0 billion in 2018 utilizing generally accepted accounting principles, commonly called GAAP. The components of that figure are $24.8 billion in operating earnings, a $3 billion non-cash loss from an impairment of intangible assets arising almost entirely from our equity interest in Kraft Heinz, $2.8 billion in realized capital gains from the sale of investment securities, and a $20.6 billion loss from a reduction in the amount of unrealized capital gains that existed in our investment holdings. A new GAAP rule requires us to include that last item in earnings. As I emphasized in the 2017 annual report, neither Berkshire's Vice Chairman Charlie Munger nor I believe that rule to be sensible. Rather, both of us have consistently thought that at Berkshire, this mark-to-market change would produce what I described as wild and capricious swings in our bottom line. The accuracy of that prediction can be suggested by our quarterly results during 2018. In the first and fourth quarters, we reported GAAP losses of $1.1 billion and $25.4 billion, respectively. In the second and third quarters, we reported profits of $12 billion and $18.5 billion. In complete contrast to these gyrations, the many businesses that Berkshire owns delivered consistent and satisfactory operating earnings in all quarters. For the year, those earnings exceeded their 2016 high of $17.6 billion by 41%. Wide swings in our quarterly GAAP earnings will inevitably continue. That's because our huge equity portfolio, valued at nearly $173 billion at the end of 2018, will often experience one-day price fluctuations of $2 billion or more, all of which the new rule says must be dropped immediately to our bottom line. Indeed, in the fourth quarter, a period of high volatility in stock prices, we experienced several days with a profit or loss of more than $4 billion. Our advice: focus on operating earnings, paying little attention to gains or losses of any variety. My saying that in no way diminishes the importance of our investments to Berkshire. Over time, Charlie and I expect them to deliver substantial gains, albeit with highly irregular timing. So, I believe this is the first year that they had to follow this rule, and he's been writing about it every year since. And this is the year that you can most clearly see why that fluctuation can be.
Yeah.
But he writes that the operating earnings are consistent, but these mark-to-market reported earnings are highly capricious, as he says. So, any thoughts on that?
Well, it just seems like that you can really feel it the first year that he's I don't know if upset's the right word, but like he's feeling it. Okay.
Yeah. Longtime readers of our annual reports will have spotted the different ways in which I opened this letter. For nearly 3 decades, the initial paragraph featured the percentage change in Berkshire's per share book value. It's now time to abandon that practice. So if we go earlier than this one, we'll see that he'll open the letters differently.
Yeah.
The fact is that the annual change in Berkshire's book value, which makes its farewell appearance on page 2, maybe he still did open it that way, is a metric that has lost the relevance it once had. Three circumstances have made that so. First, Berkshire has gradually morphed from a company whose assets are concentrated in marketable stocks into one whose major value resides in operating businesses. Charlie and I expect that reshaping to continue in an irregular manner. Second, while our equity holdings are valued at market prices, accounting rules require our collection of operating companies to be included in book value at an amount far below their current value, a mismark that has grown in recent years. Third, it is likely that over time, Berkshire will be a significant repurchaser of its shares, transactions that will take place at prices above book value, but below our estimate of intrinsic value. The math of such purchases is simple. Each transaction makes per share intrinsic value go up, while per share book value goes down. That combination causes the book value scorecard to become increasingly out of touch with economic reality. In future tabulations of our financial results, we expect to focus on Berkshire's market price. Markets can be extremely capricious. Just look at the 54-year history laid out on page 2. Over time, however, Berkshire's stock price will provide the best measure of business performance. Turn on my camera so I can make some adjustments here. Okay, any comments about that?
No, I don't have anything. What about you?
Well, he mentions that he expects Berkshire to be a significant repurchaser of its shares, and we saw in 2019, and I think every year since, 2020, 21, 22, that they did in fact repurchase.
Yeah, so he wasn't lying.
Their shares.
Yeah.
Before moving on, I want to give you some good news, really good news, that is not reflected in our financial statements. It concerns the management changes we made in early 2018 when A.G. Jane was put in charge of all insurance activities and Greg Abel was given authority over all other operations. These moves were overdue. Berkshire is now far better managed than when I alone was supervising operations. Ajit and Greg have rare talents, and Berkshire blood flows through their veins. Now let's look at what you own. Focus on the forest. Forget the trees. Investors who evaluate Berkshire sometimes obsess on the details of our many and diverse businesses, our economic trees, so to speak. Analysis of that type can be mind-numbing, given that we own a vast array of specimens, ranging from twigs to redwoods. A few of our trees are diseased and unlikely to be around a decade from now. Many others, though, are destined to grow in size and beauty. Fortunately, it is not necessary to evaluate each tree individually to make a rough estimate of Berkshire's intrinsic business value. That's because our forest contains 5 groves of major importance, each of which can be appraised with reasonable accuracy in its entirety. 4 of those groves are differentiated clusters of businesses and financial assets that are easy to understand. The 5th, our huge and diverse insurance operation, delivers great value to Berkshire in a less obvious manner, one I will explain later in this letter. Before we look more closely at the first 4 groves, let me remind you of our prime goal in the deployment of your capital: to buy ably managed businesses in whole or part that possess favorable and durable economic characteristics. We also need to make these purchases at sensible prices. Sometimes we can buy control of companies that meet our tests. Far more often, we find the attributes we seek in publicly traded businesses in which we normally acquire a 5 to 10% interest. Our two-pronged approach to huge-scale capital allocation is rare in corporate America, and at times gives us an important advantage. I'm going to comment on that. I would like to take that approach myself in owning 100% of businesses and also owning interests in publicly traded businesses.
I agree. I think it's really good to do that, and even with the government stuff, with small business loans or negotiating with the business people. There's people retiring with businesses every day that you can pick them up and figure it out.
Yeah, and Warren and Berkshire Hathaway, they own the companies. They're not running the day-to-day of the companies.
Yeah, they're owners.
If there are capital decisions, then he'll make those, but otherwise he lets the managers manage the different businesses.
Mm-hmm.
In recent years, the sensible course for us to follow has been clear. Many stocks have offered far more for our money than we could obtain by purchasing businesses in their entirety. That disparity led us to buy about $43 billion of marketable equities last year, while selling only $19 billion. Charlie and I believe the companies in which we invested offered excellent value, far exceeding the available in takeover transactions. Despite our recent additions to marketable equities, the most valuable grove in Berkshire's forest remains the many dozens of non-insurance businesses that Berkshire controls, usually with 100% ownership and never with less than 80%. That's a little bit different from last year's. He said 51%.
Yeah.
Or I should say the last one we read, which was 2019.
Yeah.
Those subsidiaries earned $16.8 billion last year. When we say earned, moreover, we are describing what remains after all income taxes, interest payments, managerial compensation, whether cash or stock-based, restructuring expenses, depreciation, amortization, and home office overhead. That brand of earnings is a far cry from that frequently touted by Wall Street bankers and corporate CEOs. Too often their presentations feature adjusted EBITDA, EBITDA, a measure that redefines earnings to exclude a variety of all too real costs. For example, management sometimes assert that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders? And restructuring expenses? Well, maybe last year's exact rearrangement won't occur, but restructurings of one sort or another are common in business. Berkshire has gone down that road dozens of times, and our shareholders have always borne the costs of doing so. Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have?
5.
And then he answered his own query.
What?
What did he answer?
4 because calling doesn't make it 1.
4 because calling a tail a leg doesn't make it 1. Abe would have felt lonely on Wall Street. Charlie and I do contend that our acquisition-related amortization expenses of $1.4 billion, detailed on page K84, are not a true economic cost. We add back such amortization costs to GAAP earnings when we are evaluating both private businesses and marketable stocks. In contrast, Berkshire's $8.4 billion depreciation charge understates our true economic cost. In fact, we need to spend more than this sum annually to simply remain competitive in our many operations. Beyond those maintenance capital expenditures, we spend large sums in pursuit of growth. Overall, Berkshire invested a record $14.5 billion last year in plant, equipment, and other fixed assets, with 89% of that spent in America. Berkshire's runner-up grove by value is its collection of equities, typically involving a 5 to 10% ownership position in a very large company. As noted earlier, our equity investments were worth nearly $173 billion at year-end, an amount far above their cost. If the portfolio had been sold at its year-end valuation, federal income tax of about $14.7 billion would have been payable on the gain. In all likelihood, we would hold most of these stocks for a long time. Eventually, however, gains generate taxes at whatever rate prevails at the time of sale. Our investees paid us dividends of $3.8 billion last year, some that will increase in 2019. Far more important than the dividends, though, are the huge earnings that are annually retained by these companies. Consider as an indicator these figures that cover only our 5 largest holdings. Now, before we looked at the retained earnings, again, he's talking about retained earnings, which he did in the last letter that we read.
Yep.
And it might be good to keep in mind when we're reading this and the other letters as we go back, what the current day figures are to see how much they've grown.
Yeah.
But we'll have that perhaps prepared for next time. But they've definitely grown quite a bit.
Yes.
Anyway, so here he lists American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo, and the year-end ownership, which in 2023 and 2024 has changed considerably.
Yeah, Wells Fargo is gone bye-bye.
From Berkshire's portfolio, yes. But
well, not the company itself, but I mean from Buffett's side, yes.
Looked like Coca-Cola had a negative retained earnings.
Yeah.
In the table there.
Is that bad?
Well, yeah, it means they had a loss.
Well, what compared to everything else, it looks like they've been winning.
Yeah, but this was years ago. Anyway.
Yeah.
GAAP, which dictates the earnings we report, does not allow us to include the retained earnings of our investees in our financial accounts, but those earnings are of enormous value to us. Over the years, earnings retained by our investees, viewed as a group, have eventually delivered capital gains to Berkshire that total more than $1 for each dollar these companies reinvested for us. All of our major holdings enjoy excellent economics, and most use a portion of their retained earnings to repurchase their shares. We very much like that. If Charlie and I think an investee stock is underpriced, we rejoice when management employs some of its earnings to increase Berkshire's ownership percentage. And that should be clear to you because we've read and understood that before.
Yeah.
When a company repurchases shares,
Yeah.
the shareholders
get bigger benefit.
They get a higher percentage of the company.
Yep.
Here's one example drawn from the table above. Berkshire's holdings of American Express have remained unchanged over the past 8 years. Meanwhile, our ownership increased from 12.6% to 17.9% because of repurchases made by the company. Last year, Berkshire's portion of the $6.9 billion earned by American Express was $1.2 billion. About 96% of the $1.3 billion we paid for our stake in the company. It's pretty amazing. When earnings increase and shares outstanding decrease, owners over time usually do well. A third category of Berkshire's business ownership is a quartet of companies in which we share control with other parties. Our portion of the after-tax operating earnings of these businesses, 26.7% of Kraft Heinz, 50% of Berkadia and Electric Transmission Texas, and 38.6% of Pilot Flying J, total about $1.3 billion in 2018. In our fourth grove, Berkshire held $112 billion at year-end in U.S. Treasury bills and other cash equivalents, and another $20 billion in miscellaneous fixed income instruments. We consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash equivalents to guard against external calamities. We have also promised to avoid any activities that could threaten or our maintaining that buffer. And he's upped that to at least $30 billion, if you remember from the more recent letters. Berkshire will forever remain a financial fortress. In managing, I will make expensive mistakes of commission and will also miss many opportunities, some of which should have been obvious to me. At times, our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash. All right, what's the difference between commission and omission? He says, I will make expensive mistakes of commission.
I'm not sure.
So commission is something that's actively done.
Yeah.
So a mistake of commission is something you actively do, like you mistakenly
buy a company overpriced or something, right?
Well, I was going to say like run into somebody's mailbox or something.
Yeah.
Or buy something that's overpriced.
Yeah.
That's more in line with the what we're reading here.
Yeah.
But a mistake of omission was something you omitted doing, something you didn't do, but it was a mistake. So like, you missed on that. You missed on buying a company that was a really good price.
Yeah.
You know, or you.
Or you missed out on the good Tesla deal.
Yeah, I mean something like that could be considered a mistake of omission.
Yeah.
Something that you omitted to do.
Yeah.
All right, so you get a vocabulary lesson, you and the viewers,
Yep.
along with the reading of the letter.
Yes.
In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. That disappointing reality means that 2019 will likely see us again expanding our holdings of marketable equities. We continue, nevertheless, to hope for an elephant-sized acquisition. Even at our ages of 88 and 95, I'm the young one. That prospect is what causes my heart and Charlie's to beat faster. Just writing about the possibility of a huge purchase has caused my pulse rate to soar. My expectation of more stock purchases is not a market call. Charlie and I have no idea as to how stocks will behave next week or next year. Predictions of that sort have never been a part of our activities. Our thinking, rather, is focused on calculating whether a portion of an attractive business is worth more than its market price. There are a lot of YouTube channels out there that talk about predictions of stocks going up or down, whether they're talking about the market in general or any one particular stock or any number of different stocks. And in our channel and our videos, we haven't done that. And
I think it's better to do it that way.
Yeah, I mean, it's very tempting because, those videos that those people do get a lot of views and people get a lot excited, really excited about making the predictions.
Yeah.
But when you read someone like Warren who says that has never been a part of his activities, making predictions of whether the stock price will go up or down.
It might be great for content, but at the same time, we don't want to make content out of expense of our viewers.
Yeah.
So, yeah.
And, You know, like he says, he has no idea how stocks will behave next week or next year.
I agree. I have no idea either.
And if you look at the history of this, you know, I remember years ago I had a subscription to the Wall Street Journal, and you know, every day it would say, you know, stocks up for this reason or stocks down for this reason. And my feeling was like, they could swap out these reasons any day of the week, and who would know any differently? Like,
yeah, like they could give the exact reason why it's up or the exact reason why it's down.
right? Like, you know, and I'm like, well, maybe they do have a good reason for, you know, printing what they do, you know, and maybe they are correct. But from my perspective when reading it, I was like, okay, they say it's because of profit taking or because of, you know, interest rates or because of some other reason, and maybe it's accurate, but and even if it is accurate, like,
yeah,
how do you make that prediction ahead of time and be correct?
Yeah,
You know, even with a decent track record. And as far as track records go, Warren Buffett has a fantastic one when it comes to investing.
yeah.
And he just doesn't do that sort of thing.
He's like the best investor in the world, in my opinion.
Yeah, and he just doesn't do those kind of stock price predictions.
Yeah.
He does look at he does make predictions as far as businesses goes, and he's looking for businesses that have the durable competitive advantage.
Yes.
He wants a business that's going to be around for a long time and do really well. And when he buys those, whether in whole or in part, the fluctuation of the stock price is less important to him, because he knows in the long run the company's going to perform well if things go well.
Yeah.
You know, he does what he can to
Make sure that happens.
Yeah, pick those kind of businesses.
Yeah.
Any further on that? Or should I get back to the letter?
Back to the letter.
I believe Berkshire's intrinsic value can be approximated by summing the values of our 4 asset-laden groves and then subtracting an appropriate amount for taxes eventually payable on the sale of marketable securities. You may ask whether an allowance should not also be made for the major tax costs Berkshire would incur if we were to sell certain of our wholly owned businesses. Forget that thought. It would be foolish for us to sell any of our wonderful companies, even if no tax would be payable on its sale. Truly good businesses are exceptionally hard to find. Selling any you are lucky enough to own makes no sense at all.
Agreed.
The interest cost on all of our debt has been deducted as an expense in calculating the earnings at Berkshire's non-insurance businesses. Beyond that, much of our ownership of the first 4 groves is financed by funds generated from Berkshire's 5th grove, a collection of exceptional insurance companies. We call those funds float, a source of financing that we expect to be cost-free, or maybe even better than that over time. We will explain the characteristics of float later in this letter, and he's explained it a few times before, so
Yeah.
it's repetition, but it's good for learning.
That's good repetition.
Finally, a point of key and lasting importance. Berkshire's value is maximized by our having assembled the 5 groves into a single entity. This arrangement allows us to seamlessly and objectively allocate major amounts of capital, eliminate enterprise risk, avoid insularity, fund assets at exceptionally low cost, occasionally take advantage of tax efficiencies, and minimize overhead. Now, if you want to take notes while you're reading this, because there's any words you don't understand, I might not always go back and give definitions for every word. But for a word like insularity, if you don't know what that is, you may want to copy it and then look it up later.
Okay.
So that
So
when reading this stuff, my goal is that you have 100% or as close to 100% of reading comprehension as possible.
yeah.
To me, it's important to fully comprehend something
Mm-hmm.
so that,
Well, just it's important.
well, otherwise it's kind of a waste of time. Like, you spend the time reading it and you don't actually know what it says. Like,
Yeah.
what did you actually gain from it?
Yeah. Oh, there's a lot I gain from the stuff that I know, but there's some stuff that I don't always know. So for next time, I don't think we'll have it in person. I'll have a notebook. So yeah, and I have a pen always on hand. So
Yeah, you can do that. But you can also, like, if you're on your laptop or phone, you can copy and paste and keep a little electronic document of
it's
vocab
better to
words.
write it down, in my opinion.
Oh, yeah, actually, you're probably right. I think you're right, but you know, use whatever tool you've got. If you don't happen to have the pen and paper, don't use that as an excuse not to
Yeah.
make a note of stuff. I just looked up insularity on an online dictionary, and it says ignorance or lack of interest in cultures, ideas, or peoples outside one's own experience.
Oh, that's not good.
Right. So
We
he's
don't wanna do
he's
that.
saying by assembling all these different business interests in one group, he eliminates or avoids insularity, which is
like ignoring other groups of people or cultures.
Yeah, ignorance of stuff happening outside of your own experience.
Yeah.
So, and you can see how that would be the case. His businesses are so diverse. One business, they're focused on what they're doing.
Yeah.
If that's all they're focused on, then they're missing
the bigger picture.
Yeah, the bigger picture of what's going on. And Berkshire is able to avoid that sort of ignorance or that sort of narrow-mindedness or that overly closed focus.
Yeah.
Okay. As well as the other benefits that he mentions here. And any of these benefits that you don't understand. I want to keep going so that we get through the letter. But as part of like a self-study thing, any of these other things that he mentioned, you can take note of. And that goes for you or anyone else listening or following or watching or following along.
Yes.
And we're hoping that the viewers do follow along. We have the letter up. I don't know. And if it's not clear for them, for any of you viewers, yeah, you can find this letter pretty easily online. And I'm going to read this last sentence, and then we'll take a moo break. At Berkshire, the whole is greater, considerably greater than the sum of the parts.
Alrighty, it's moo time. Moo, go in the link in the description, the TnT Podcast. Get up to 15 stocks and get an extra 3% APY. You can be getting 8.1% APY for the next 3 months. Just deposit $100, get 5 stocks, deposit $1,000, keep it in there for 90 days, and get 15 stocks. So basically getting 8% right now. So put some money in there. All right, thanks.
All right, that was great. Fantastic. Okay, repurchases and reporting. Earlier,
actually, with the new 3% bonus, I'm gonna put some money in there.
Of course.
I'm gonna use your moo link.
Great, yes. You and a whole bunch of other people. Let's get them in there. You know what? We could also we haven't done it yet, and maybe I should wait until we actually do it to discuss it. But we could start a little chat group in Moo.
Oh.
So viewers of the TnT Podcast could join us in the chat group.
Oh, that would be cool. Yeah.
So. That's another project we could look into and do. I think we could do that, right?
Yeah.
Okay. Repurchases and reporting. Earlier, I mentioned that Berkshire will, from time to time, be repurchasing its own stock. Assuming that we buy at a discount to Berkshire's intrinsic value, which certainly will be our intention, repurchases will benefit both those shareholders leaving the company and those who stay. True, the upside from repurchases is very slight for those who are leaving. That's because careful buying by us will minimize any impact on Berkshire stock price. Nevertheless, there is some benefit to sellers in having an extra buyer in the market. For continuing shareholders, the advantage is obvious. What is it? What's the advantage? Without reading it, you should know that their percentage of the company that they own goes up.
Oh yeah. If a company buys it, right, 10%, then they own 10%. Well, now they really own, would it be 11%?
Yeah, approximately. Yeah.
Yeah.
All right, let's see what Warren actually writes here. He says, for continuing shareholders, the advantage is obvious. If the market prices a departing partner's interest at, say, 90 cents on the dollar, continuing shareholders reap an increase in per share intrinsic value with every repurchase by the company. Obviously, repurchase should be price sensitive. Blindly buying an overpriced stock is value destructive, a fact lost on many promotional or ever optimistic CEOs. Yeah, it's what we said, but he's couched it in some language that's perhaps not clear if you don't understand what he's saying. But when a company says that it contemplates repurchases, it's vital that all shareholder partners be given the information they need to make an intelligent estimate of value. Providing that information is what Charlie and I try to do in this report. We do not want a partner to sell shares back to the company because he or she has been misled or inadequately informed. Some sellers, however, may disagree with our calculation of value, and others may have found investments that they consider more attractive than Berkshire shares. Some of that second group will be right. There are unquestionably many stocks that will deliver far greater gains than ours. In addition, certain shareholders will simply decide it's time for them or their families to become net consumers rather than continuing to build capital. Charlie and I have no current interest in joining that group. Perhaps we will become big spenders in our old age. They're already in their old age. But he writes like he's not.
Yeah.
For 54 years, our managerial decisions at Berkshire have been made from the viewpoint of the shareholders who are staying, not those who are leaving. Consequently, Charlie and I have never focused on current quarter results. Berkshire, in fact, may be the only company in the Fortune 500 that does not prepare monthly earnings reports or balance sheets. I, of course, regularly view the monthly financial reports of most subsidiaries, but Charlie and I learn of Berkshire's overall earnings and financial position only on a quarterly basis. Furthermore, Berkshire has no company-wide budget, though many of our subsidiaries find one useful. Our lack of such an instrument means that the parent company has never had a quarterly number to hit. Shunning the use of this bogey sends an important message to our many managers, reinforcing the culture we prize. And I think we should get that book that he mentions earlier about Berkshire culture.
Mm-hmm.
Over the years, Charlie and I have seen all sorts of bad corporate behavior, both accounting and operational, induced by the desire of management to meet Wall Street expectations. What starts as an innocent fudge in order to not disappoint the street, say trade loading at quarter end, turning a blind eye to rising insurance losses, or drawing down a cookie jar reserve, can become the first step toward full-fledged fraud. Playing with the numbers just this once may well be the CEO's intent. It's seldom the end result.
So basically, don't play with the numbers, is what he's saying.
Yeah, and if it's okay for the boss to cheat a little, it's easy for subordinates to rationalize similar behavior.
Yeah.
And when that happens,
It's a big problem.
Yeah. At Berkshire, our audience is neither analysts nor commentators. Charlie and I are working for our shareholder partners. The numbers that flow up to us will be the ones we send on to you. Any comments on that?
No.
All right, non-insurance operations, from lollipops to locomotives. Now let's look further at Berkshire's most valuable grove. Our collection of non-insurance businesses, keeping in mind that we do not wish to unnecessarily hand our competitors information that might be useful to them. Additional details about individual operations can be found on pages K5 through K22 and pages K40 through K51. Viewed as a group, these businesses earned pre-tax income in 2018 of $20.8 billion, a 24% increase over 2017. Acquisitions we made in 2018 delivered only a trivial amount of that gain. I will stick with pre-tax figures in this discussion, but our after-tax gain in 2018 from these businesses was far greater than 47%, thanks in large part to the cut in the corporate tax rate that became effective at the beginning of that year. Let's look at why the impact was so dramatic. Begin with an economic reality. Like it or not, the U.S. government owns an interest in Berkshire's earnings of a size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock. Call this holding the AA shares. That receives large dividends, that is tax payments, from Berkshire. In 2017, as in many years before, the corporate tax rate was...
Is that the difference between A and B for Berk A?
No.
Oh.
Let me finish this paragraph and I'll address it. In 2017, as in many years before, the corporate tax rate was 35%, which meant that the Treasury was doing very well with its AA shares. Indeed, the Treasury stock, which was paying nothing when we took over in 1965, had evolved into a holding that delivered billions of dollars annually to the federal government. Do you remember how in the other letters that we read, he said that there is a relationship between government and business. It's like a partnership.
Yeah.
And how America would have done fine without Berkshire, but the reverse is not true.
Yeah.
Okay, so and here he's saying you could call the what the government owns of Berkshire an AA stock. It doesn't actually exist, but by virtue of Berkshire being a corporation that's incorporated inside the United States,
Yeah.
Berkshire must pay taxes.
Yes.
And you could look at those taxes as if they were a dividend that the government collects.
Okay. Yeah.
So,
I thought that was like a huge dividend on Berk A, and I was like, what?
no, he's comparing the fact that he has to pay taxes.
Yeah.
He's making an analogy, or he's saying it's kind of like the government owns these, has an interest in the company that allows it to collect these dividends. But they're not dividends, they're taxes.
Yeah. I get that.
He's just rephrasing, he's just painting a picture of it using these words.
That makes more sense. Yeah.
Okay. Last year, however, 40% of the government's ownership, 14/35, was returned to Berkshire free of charge when the corporate tax rate was reduced to 21%. Consequently, our A and B shareholders received a major boost in the earnings attributable to their shares. This happening materially increased the intrinsic value of the Berkshire shares you and I own. The same dynamic, moreover, enhanced the intrinsic value of almost all of the stocks Berkshire holds. Those are the headlines, but there are other factors to consider that tempered our gain. For example, the tax benefits garnered by our large utility operation get passed along to its customers. Meanwhile, the tax rate applicable to the substantial dividends we receive from domestic corporations is little changed at about 13%. This lower rate has long been logical because our investees have already paid tax on the earnings that they pay to us. Overall, however, the new law made our businesses and the stocks we own considerably more valuable, which suggests that we return to the performance of our non-insurance businesses. Our two towering redwoods in this grove are BNSF and Berkshire Hathaway Energy, 90.9% owned. Combined, they earned $9.3 billion before tax last year, up 6% from 2017. You can read more about these businesses on pages K5 through K10 and pages K40 through K45. Our next 5 non-insurance subsidiaries, as ranked by earnings, but presented here alphabetically, Clayton Homes, International Metalworking, Lubrizol, Marmon, and Precision Cast Parts, had aggregate pre-tax income in 2018 of $6.4 billion, up from the $5.5 billion these companies earned in 2017. The next 5, similarly ranked and listed, Forest River, Johns Manville, Mytech, Shaw, and TTI earned $2.4 billion pre-tax last year.
So wait, what are all these companies?
These are all subsidiaries. These are all companies that Berkshire owns.
Do they own all these?
They own all of these.
Like 100%?
As far as I know, yes, 100%.
Wow.
And guess what? Uncle Vaughn asked me if, because he watched yesterday, was that part 3?
Yeah.
He watched part 3 of episode 5. Or, I mean, it was episode 5.
Part 2. It was part 2.
It's part 2 of it. What? I don't know what the namings and the numbers are, but
yeah.
It was the 2019 letter.
Yeah.
The last part of it.
Yeah.
He watched it, and he asked if the letter covered Forest River.
Yeah.
And it did not, but 2018 does. Yeah, because he, I'm pretty sure Forest River is a customer of his.
Okay.
So, anyway. I only have one more sentence to read, and then we can discuss this more if needs, because that's the end of the section.
Yeah.
Okay, so they earned $2.4 billion pre-tax last year, up from $2.1 billion in 2017. The remaining non-insurance businesses that Berkshire owns, and there are many, had pre-tax income of $3.6 billion in 2018 versus $3.3 billion in 2017. Okay, so are we going to keep going? Because
we can stop here if you want.
Do you want to stop here?
Yeah, we're going to stop here. Thank you guys. This is episode 7. And thank you guys for watching. Sorry it's not 100% live, but enjoy the rest of your day.
And check out the Moo Moo app.
Moo Moo app one more time. Peace out.